Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. So here's the latest this morning. The president threatening House Republicans taking a stand against his tariff agenda. The president posting on Truth Social, there will be consequences after 6 GOP lawmakers crossed party lines to rebuke the president's levies on Canada. The Republican Congressman French Hill voting against the measure to override President Trump's tariffs, and he joins us now for more. Congressman Hill, welcome to the program, sir. Your reaction to what happened on the Hill yesterday and why you voted the way you did?
Well, good morning, Jonathan. Look, I think we should handle the tariff discussion in a more comprehensive way and not take votes every week on the floor that turns the House floor over to the Democratic Party. That's why I believe that standing with Speaker Mike Johnson on this maintains Republican control of the floor. So this is a very important strategic issue in a parliamentary body like Congress with a very narrow majority. What we should be doing about trade is urging the president to renew USMCA with Canada and Mexico, which is under review for its 5-year review this summer. It's a very important trade arrangement for the 3 countries. Progress is being made in working with the Canadians and the Mexicans. So that's number one. It's not to be connected, in my judgment, to the vote last night, which is, did the president have the right to put tariffs on Canada under IEEPA because of the fentanyl matter? You get my point. Let's stick with the big picture here, which is growing America's exports, growing America's influence, using tariffs as a tool to change trade behavior of other nations. Number one on that list, of course, is China.
Congressman, you mentioned USMCA. Our team down in Washington, I'm sure you're familiar with the work of Josh Wingrove, wrote just yesterday that the president is privately musing about exiting the North American Trade Pact. That according to people familiar with the matter. When you read a story like that, do you just consider that part of the negotiation for the upcoming negotiations, or does that concern you?
Yeah. No, I do, because of the way President Trump is responsible for dramatically improving the North American Free Trade Agreement from the 1992-1993 timeframe in creating USMCA in his first term, and it worked quite well. But there's more to be done on Canadians on dairy or Canadians on softwood lumber, or how the automotive business works back and forth between the 2 countries, or now the role of IT. We live in an ever-changing economy with ever-changing priorities, but let's face the reality that 30% of GDP in my home state of Arkansas is connected to cross-border trade with Mexico and Canada. So the agreement is important, and it's also important for you to note in that comment that President Trump has, does not impose additional tariffs on USMCA compliant goods. So we are living by the agreement.
Congressman, there's a trade-off here, and I think a lot of people would be sympathetic with the idea of trying to get certain trade partners to change behaviors, and thinking particularly of China. On the other hand, there's a real affordability crisis, and this is a real issue for a whole host of representatives who are coming up for election later this year. I just wonder how much influence you think that Republicans on the Hill have over President Trump's negotiations around tariffs to potentially either abstain from putting additional ones on or rolling some of the existing ones back.
Well, what you've seen him do is fine-tune the efforts with individual countries or regions like the EU, UK, Japan, for example. I want to see the consolidate the wins from those agreements that he's done over this first year in the first place. Secondly, you've seen him roll back some tariffs on commodities that we don't make here in the United States, but we need to use, whether it's a fruit or vegetable or a coffee, for example. And I think that makes sense. You don't want to burden the consumer as you're attempting to change trade policies in other countries, or compel them to follow Americans' lead on something like transnational drug cartel, countering those drug cartels. But on the affordability side, Lisa, I think the most important thing we can do is stay focused on the supply side. the One Big Beautiful Bill last year, signed into law by President Trump, will see real wage increases this year for American families. In Arkansas, we expect some $10,000 in benefit to a family of four from the increased child tax credit, the lower taxes on tips, the use of the standard deduction, lower taxes on seniors' Social Security. Yeah. So on that supply side, combined with what we're doing on regulations and the proposal I made for housing in the 21st Century Housing Act, we got 390 votes on the House floor for that this week.
I personally would like to boost consumption by taking a flight to a number of places in the next week, and I'm just wondering if TSA is going to be in operation. Is the government going to shut down tomorrow night, Congressman?
Oh, Lisa, I hope not. Look. It was so hard on my TSA agents in Little Rock and up in the tower at Little Rock National Airport, the air traffic controllers. That was a bad 42 days. That's not how to run the government. President Trump has used Tom Homan as a leader to consolidate both ICE and CBP operations in Minneapolis, bring transparency to the operation, streamline it, make sure the training is in place, make sure the operation is consistent with federal law. They're using body cams. Let's take that as the right direction and keep our government funded in Homeland Security. So important to so many people.
Congressman, it just feels messy down in Washington, but you pointed out the Housing for the 21st Century Act. We can get things done. We can find support on both sides. Congressman, what was actually achieved down in Washington, and how important is that to you?
Well, it's very important. You know, Jonathan, on the priorities I've had to have conservative center-right policy on redirecting regulation and policy for people's investment opportunities, more crowdfunding, more public offerings, community banking, making community banking great again by lowering the regulatory burden on small banks that make 60% of the home loans in this country. And now 21st Century Housing, we got 300 votes for those policies, as we did for our digital assets and crypto work last year. That shows that Republicans and Democrats, when it comes to economic policy, can get on the same page and pass legislation that President Trump should sign into law that will make people's lives better. Costs will be brought down. Supply side capital will advance. And community banking will thrive in this country. And those are all good things.
Final question, Congressman. I've got about 20 seconds. Are you happy you don't have to chair the House Judiciary Committee? Because that was wild yesterday.
Well, I had a pretty wild hearing last week with my ranking member and Mr. Besant's testimony. So I know wild, but it was. But that's what happens on Capitol Hill. We bring the public and their elected representatives together to try to find solutions, and it can get spicy sometimes.
Stay with us. More Bloomberg surveillance coming up after this. Let's talk about European equities climb to fresh record highs. The Stock 600 outperforming the S&P 500 so far this year. Sharon Bell of Goldman Sachs writing, the surge for insulation from AI disruption risk has accelerated the ongoing cyclical rally in the US. We continue to see rising allocations to Europe as a diversifier with reasonable valuation. Sharon joins us now for more. Sharon, welcome to the program. Let's just build on what you've just written there. The idea that Europeans are starting to look at home again. Are Americans looking abroad? Are they participating in this?
I think it's both. In fact, I would say it's more American investors, US dollar-based investors that are worried that the US market looks expensive. They're very concentrated in their positions in the US dollar. You've got 4 or 5 companies which are all big bets on one thing, AI. So that may pay off, but you don't know. And it just leaves you with some risk. So people wanting to diversify, including US investors, but domestic investors too. Both have been buying Europe this year.
Sharon, apart from just being European, what is the diversification in Europe? What does it offer?
Yeah, offers very different sector exposure, I would say. I mean, there is a tech sector, obviously, in Europe, but it's much smaller than the sector in the US. You don't have the large hyperscalers, not spending as much in the way that the hyperscalers are in the US. So very different from a tech sector perspective. But also, and I think this is more important, Europe offers things like much more exposure to, as a share of the index, to commodity-related areas, materials, industrials, financials, which have all in the last year performed very well. well.
Yeah, I'm thinking about Glencore, for example, or Shell, or some of the big banks that have also done pretty well in the region. I just am curious, though, if someone is looking internationally and they're not from Europe, why not go to Asia? What is the draw to Europe that has better exposures that's going to somehow outperform at a time when there's a real kind of question around how much they can break out from some of the crosswinds coming from both the U.S. and China?
Absolutely, and I agree with that. Our philosophy has been you want to broaden your exposure and diversify, not just into Europe, but into Asia, into emerging markets. We've just upped our emerging market targets, for example. So, and actually, Asia and emerging markets have seen better earnings performance this year and have performed extremely well, better than Europe and the US stock market. So I think there's plenty of opportunity globally to diversify, including Europe, as part of that as well. But I do agree there are headwinds for Europe. I mean, economic growth is slower in Europe than elsewhere, although it's still positive and it's being boosted, obviously, by the fiscal spend in Germany. But yes, there are headwinds, such as China competition, although I do think European policymakers are starting to acknowledge this now.
You know, we're talking about the motivation, and we talk about the Sell America trade, which has become cliche. It feels like a little bit different than that, and that's the reason why we keep going back to this George Saravelos of Deutsche Bank note, where he's talking about the loss of safe haven status for the dollar, not necessarily in the sense that it's going to go to zero, but you're not getting the same diversification feature in terms of the dollar outperforming when risk assets sell off. How much do you see that as a driver? Not just people wanting to look home or some of the emotions of the moment.
Yeah, I think it's definitely that there's often when you see a change in trend, there isn't one single driver of it. There's several drivers. I think we talked about the diversification sector exposure. I mentioned valuation differences, but I also think concern about having all your exposure in dollars and wanting to diversify that is also another element of this. And the euro, sterling, Swiss franc provides different currency exposure as well. So I think there's many elements to this desire for global investors to diversify and broaden out their exposures.
There's a lot of anticipation about how much money is going to be spent on AI, and the beneficiaries of that, Sharon, as you know, it's a big thing for the year ahead as well, with $650 billion of capex coming from just 4 companies, which is just absolutely absurd. People are thinking about the miners, Sharon, in a much bigger way. And when I think about miners, I think about the FTSE and some of the listings for UK equities. Are you seeing that generate some bigger returns for large cap UK?
Absolutely. FTSE 100 has done extremely well this year. Index targets have generally been raised. I think, in honesty, it's an index which has been ignored for 10 or 15 years by global investors and domestic UK investors. Doesn't really have very much tech exposure. It's got a very different type of exposure, but that's actually doing quite well at the moment. It's also an index which looks relatively inexpensive. So the UK market still trades at 13.5 times PE, which is not quite half what the S&P trades on, but not far off.
Stay with us. More Bloomberg surveillance coming up after this. The Federal Reserve facing a busy week of data on both sides of the central bank's mandate. The US economy delivering a blowout payrolls report ahead of a fresh read on inflation with CPI due tomorrow. Stephen Ricchiuto of Mizuho writing the first half of the year is seen benefiting from strong individual tax refunds, and the second half from last year's 75 basis point reduction in the funds rate. Steve joins us now for more. Stephen, welcome to the show. It's always good to catch up with you, sir. How much weight should we put on that payrolls report? Is it the real deal?
Well, I think when you back it up against the claims data that we've been seeing on a regular basis, I mean, ignore last week's numbers. When you look at where claims are, you look at where continuing claims are, and you look at the decline in the exhaustion rate, i.e. people falling off the continuing claims roll, you're seeing a healthier labor market environment, and you're seeing it actually picking up speed. You see a healthy labor market environment in the NFIB numbers. You saw some healthy data in the ISM numbers. I think, you have to look at all this data and say, well, why is it taking place the way it is? And I think the answer is because the economy is fundamentally healthy. And I think it is going to accelerate as we go forward into 2026. And I don't worry about the second half of the year, as I wrote in that little piece, because primarily we think the interest rate story comes up to really replace the tax cuts as the driver of the economy as we go into the second half of the year. Remember, in 2025, we had a real acceleration in growth in the second half of the year after a disappointing first half of the year. And the Fed was all worried about the first half growth decline, and that's what they used to justify the rate cuts. But at the end of the day, the economy accelerated in the second half as a result of the rate cuts in 2024, and I think that continues to dominate again this year.
Well, Steve, I want to pick up on that point, the 12-month lag. What is the 12-month lag about? Because for someone just following financial markets, I might sit here and say, highly financialized economy, it goes through financial markets almost immediately, and you can feel the effect straight away. What takes 12 months?
It takes 12 months for people to reassess their situation. And we're really talking about a 6-month lag, which I think is the important piece of the equation, because, there's usually this belief that monetary policy takes anywhere from 6 months to 18 months to be reflected in the economy, the long and variable lags that all Fed chairmen like to talk about. But the reality of the situation is those long and variable lags really depend on the underlying health of balance sheets. And I know you were talking before about the K-shaped economy and the adjustments taking place in the economy. But when you look at where the economy is and you go back, you're looking at 5 years ago, which was the COVID environment. And we're renormalizing to a pre-COVID environment. And that's what you're seeing in a lot of the data. When you look at things like delinquency rates relative to balances are very low, so delinquency rates look high. But when you scale them by income or you scale them by GDP, suddenly delinquency rates don't look to be a problem. This is all the type of normalizing analysis that I think we've been doing relative to other people that I think is really, really driving the point that this economy is on a solid fundamental trajectory. And I disagree completely about the argument that we're going to get inflation coming down. We've been talking about inflation coming down from 3% for several years now, and it isn't happening. How long are we going to continue to wait for Godot? That's the real problem, because the Federal Reserve has to wake up and smell the roses, and inflation is stuck at these levels.
We'll get to inflation in just a second. I'm just curious. I'm dealing with whiplash right now after David Tinsley was just telling us that the middle class is falling into the same type of affordability crisis as the lower income individuals in this country. How do you square that story with this idea that there is stimulus that is working its way through the system?
Well, I think you come around with the fact that the corporate stimulus came last year. The consumer kit stimulus comes this year. A lot of people are just now filing their tax returns. They're just now getting their refund distributions. We're on the real exponential rise in refund check distribution. So we expect to start seeing it showing up in the data in the next couple of weeks. With regard to the concept of the middle income households, remember, you just went through the longest government shutdown in history. You went through a very, very cold winter, early winter environment. You went through the reciprocal tariff adjustments of last year. So seeing some disruptions get developed as a result of that is not surprising. It's where do we go forward that becomes the critical issue. The indicators that he's been looking at are basically indicators that tells you where we were, and not looking at, well, if the economy does get the cyclical boost we're expecting, if labor markets do get the cyclical improvement we're expecting, then guess what? You wind up reversing all those trends after being worried about them for so long.
Stephen, going back
to the data is beginning to show that's happening.
Going back to the inflation point that you're making, the pushback that you're hearing across Wall Street, and Tiffany Wilding of PIMCO put this out there, that after a period of stubbornly high rental housing inflation, you're actually seeing the opposite, surprisingly low housing-related inflation. And this is being borne out in a whole host of different data. I'm just wondering, where is the inflation going to come from?
Well, you're going to see it in the good side. I mean, we honestly believe that the acceleration in growth in the economy is going to lead to a greater demand pull equation. We think we're going to see it in a lot of those factors that really lead to higher prices. A tighter labor market environment will lead to higher wages. Higher wages will help contribute to stronger demand. Stronger demand will contribute to higher prices in some of the areas where good prices have been declining. This is why CPI is an index. It's not one component. And this is the thing everyone keeps on forgetting about CPI. Remember, 2 years ago, it was all about, oh, my God, you got to ignore the rising insurance rates that were driving CPI higher. The reality is you can't ignore rising insurance rates. You can't ignore all the other components. You have to look at the aggregate of the index. That's what really matters, is the aggregate, not all these individual components. You look at the number of components. I can always find something to hang my hat on to be bullish. Like, people looked at the payroll employment number, and they started doing some really apples to oranges comparisons in the birth-death model. The reality is it's the best data we have. Stop arguing with the data. The data is the data. Accept the data for what it is. Make your analysis off the data. Stop looking for arguments within the data to discredit the data.
Steve, don't stop. This was great. Steve, it's good to see you. I've got 20 seconds. Quick question. Next move, hike or a cut at the Federal Reserve?
Nothing. They do nothing for at least 12 months.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.